In 17th century Holland, a single tulip bulb surged in price, reaching 10 times a skilled craftsman's annual salary, equivalent to an entire house. Why did humanity plunge into such madness? This unprecedented surge led to the world's first major bubble collapse, stripping thousands of wealthy individuals of their fortunes overnight and plunging the national economy into decades of chaos. Yet, beneath this failure lay structural causes that continue to repeat in modern times. What was this market madness that humanity repeatedly succumbs to? In this documentary, we delve into why a flower bulb came to cost as much as a house, who fueled the frenzy, who suffered the most, and what lessons it holds for today. Let's uncover the full story of the tulip bubble, an event that shook the world. The main feature will also elaborate on the social conditions and human psychology of the era. In the 17th century, the Netherlands entered its golden age, thriving in trade and finance. It was an emerging nation that accumulated vast wealth, a period when culture and science flourished. Amidst this prosperity, tulips arrived from Turkey. Their exotic beauty quickly captivated the wealthy, establishing them as a special commodity. Tulip bulbs distinguished themselves from other flowers with their rarity, unique colors, and the mystique of blooming anew each year. Tulips soon became a symbol of wealth and status for aristocrats and prosperous merchants. Displaying them in one's garden was a clear mark of social success. Particularly popular were varieties known as broken tulips, where a virus caused intricate patterns of spots and stripes on the petals. Their unpredictable beauty enchanted people. The occurrence of these breaks relied purely on chance, making it impossible to replicate the exact same pattern. This uniqueness gave such bulbs an unparalleled value. Scarcity drove prices higher. Wealthy collectors, eager for rarer varieties, began to invest considerable sums without hesitation. The Semper Augustus variety, in particular, with its extreme rarity and vivid colors, became the most highly traded. It was truly an investment target for the wealthy elite. Tulip bulb trading evolved into futures contracts, where the ownership of bulbs still in the ground was bought and sold. These futures contracts allowed profits to be made purely from market price fluctuations, even without the physical bulbs. This quickly drew in many people. Tales of quick riches spread like wildfire, and people began to dream of striking it rich through tulip trading. This marked the beginning of an intense speculative fever. Furthermore, credit trading was introduced. Even with limited cash on hand, people could borrow money to purchase bulbs and resell them for a profit. This fostered the belief that immense profits could be made with minimal capital, drawing many into the market. The expectation of returns overshadowed the risks. The market became even more active, with prices soaring endlessly. The trading floor reached a fever pitch as everyone frantically sought the next buyer. This rapid price increase seemed to create an illusion of wealth redistribution. Everyone felt like a savvy investor. The market steadily expanded, and tulips were no longer mere flowers. They became the center of the Dutch economy, seen as magical bulbs capable of generating immense wealth. However, this fervor gradually enveloped not just the wealthy, but ordinary citizens too. Farmers, craftsmen, and even housewives began investing their entire savings. The soaring prices had completely detached from the tulip's intrinsic value. People were consumed by the illusion that they could always sell for a higher price. Speculation intensified, with people buying up bulbs, even mortgaging their homes, land, and household possessions. They desperately sought to join the frenzy, accumulating debt. Market rationality became paralyzed, and sound judgment vanished. Everyone was trapped in the short-sighted belief of buy early, profit big, becoming blind to the risks. Governments and some economists issued warnings, but their voices were drowned out by the clamor of the frenzied market. No one was willing to listen. The speculative fever gradually pushed people towards unethical behavior. Counterfeiting and fraud became rampant, eroding trust in the market. People were dominated by the fear of missing out, FOMO, deluding themselves into believing that not participating in the market was the biggest loss. But a trap lay open, unnoticed by all. Price increases could not last forever. The footsteps of ruin were drawing near. Why couldn't this madness be stopped? The primary cause was groupthink. Everyone believed that since others were profiting, they would be safe too. Furthermore, the Concord fallacy was at play. Having already invested vast sums, people feared that withdrawing now would render all their previous investments worthless. Information circulating in the market was always conveniently optimistic. Only success stories of price surges were shared, while risks and failures were concealed. Some wealthy individuals and intellectuals understood the abnormal situation, but in the face of market frenzy, they either could not or would not speak out. Many people were blinded by immediate profits, unable to consider future risks. They didn't want to be the only ones losing out when their neighbors were profiting. This frenzy was sustained by the unfounded hope that someone else would pay even more. This is famously known as the greater fool theory. Fearing they'd miss the selling window, many rushed to buy, driving prices even higher. No one could discern when this game would end. As the countdown to ruin silently advanced, market participants found themselves caught in a vortex of their own desires and those of others, losing sight of any exit. In February 1637, signs of change finally appeared in the market. Auctions in Amsterdam frequently saw no buyers, a startling development. This small anomaly ignited widespread fear. The fact that bulbs, once believed to be sure to sell, suddenly found no buyers was a profound shock. Fear quickly spread throughout the market. Buyers vanished, leaving only sellers. Prices plummeted, and everyone scrambled to offload their bulbs. Bulbs once worth an entire house became virtually worthless in mere weeks. The market plunged into panic, a scene of chaos and despair. Credit transactions also collapsed in a domino effect. Those who bought bulbs on credit were left with insurmountable debts, unable to sell. Countless households were driven to bankruptcy. The national economy suffered a severe blow, and the ensuing chaos lasted for decades. The world's first major bubble collapse left deep scars on Dutch society. The Tulip Bubble, as humanity's first significant economic bubble, imparted invaluable lessons to subsequent financial markets. Excessive speculation, information asymmetry, crowd psychology, and valuation disconnects. These are dangerous signs common to modern bubbles as well. Why did a bulb come to cost as much as a house? It was because the market, having lost its rationality, depended on the existence of greater fools. Who fueled the frenzy, and who suffered the most? It was the speculators who capitalized on the madness, and the unsuspecting ordinary citizens who were swept into it. What is the lesson for today? It is the importance of cultivating calm judgment and the ability to discern intrinsic value, rather than being swept away by market euphoria. The quality of economic decision-making will undoubtedly differ significantly between those who know this history and those who do not.